technology cycle, which I call it Internet 2.0. Internet was the first cycle for how to distribute information bottoms up around the world efficiently. Bitcoin and blockchain, more importantly, are about the digitization of all financial assets and money. That is more important than information, if you can calculate it, especially in monetary terms. So I see it in its early stages like the dot-coms. Why do I think Bitcoin's going to crash? Because it's bubbled up out of nothing and it's not really worth that much yet. But it is the potential standard for a whole new digital blockchain version of money and a whole different way of valuing and monitoring and trading and dealing with financial assets, which everybody has to do. And so it is the next big thing. I see it literally, Richard, following the internet, the dot-com surges, which bubbled up into early 2000, crashed, including Amazon. You see Amazon today, right? Is it a great company? Is it dominate the world? It was a new emerging company. It bubbled up to 136 from 6 in that bubble and then crashed 95% back to 6. Now it's at 3,500 or whatever, okay? I see Bitcoin and blockchain on that same trajectory, early stage bubble, which, by the way, for me, confirms this is the next big thing. Biotech and other major new technology, look at 3D printing, just name them all. None of them has bubbled like Bitcoin and blockchain. Only the internet and dot-com stocks bubbled that much, which was saying they were the next big thing. What most people didn't expect, if you don't study cycles like me and technologies and how they merge, is that first bubble will get overvalued tremendously because people see the future and not realize it's going to take 10 to 20 years to get there. So Bitcoin's about to crash back to maybe 3, 4, 5,000 and then go to 500,000 or more. That's what I see.
I would say that historically, every 10 years or so, you get a dip in the stock market, and cycles do exist. But those cycles,
every 40 years, you get much bigger ones. Look at that one. Even more clear.
Which is also why you get the rioting in the streets as well, because the kids forget how shitty things can be, whereas the people that have been to war enjoy their peace a little bit more than those that have never seen it get bad. So I understand the super cycles concept and the generational effect that is, wrought upon the economy. So the problem I have with bears in general is that, one, they're all extinct. The only people that have made it in the market.
Exactly. That's why you should listen to the last few standing. That's exactly what bubbles do. Extinguish all the bears till there's not one left, and then they crash and take everybody down in the Titanic. That's exactly the insight. You wouldn't expect many bears to be surviving at this point. If you did, you'd be saying the bubble's not over yet, if you understand bubbles.
Well, the thing is, so everything that you're saying can be, you're not trading markets against a real currency. You're trading markets against a fake currency, which is backed by nothing. Because the trading pair that you're trading,
Bitcoin is backed by what? What is Bitcoin backed by?
Well, the same thing that all the other markets.
You're saying that's a true currency, right? I'm assuming.
No,
they're all backed by? It's an invisible coin backed by not even
just
gold.
Like the
has
dollar.
Some intrinsic value.
Well, gold is down from 10 years ago today.
Yeah, and I've been predicting that, by the way. I'm a gold bear.
Okay. Well, then you got wrecked this year, but it's back down from 10 years ago.
I don't predict it every day, Richard. Don't hold me to stupid stuff. Like, don't even think of saying something stupid like that to me. Doesn't mean I'm bearish every week, every month.
Well, just tell me your time frame.
I've been telling people say gold, they think we're going to have an inflation crisis out of printing endless money, and I'm saying no. The printing is to offset deflation, and gold is an inflation hedge, not a deflation hedge. That's why I'm bearish on gold, and gold is going to go lower in the next few years. Mark my words on that. That's what I'll leave it at.
Sure. Like I think Warren Buffett gets a lot of things right. And one of the things that he gets
like what?
Right,
like what?
He's occasionally the richest guy in the world, which isn't
he
too bad.
Started investing in 74 and a nutless monkey. I hate to say it, could have made almost as much money if you started then.
But no one did. I mean,
that was at the bottom of the stock market of our entire lifetimes. Whoever started there, which he did, that's when he really started investing seriously, would have done very, very well just with any bullish bias. I'm not saying he's a good investor, but I don't say he's the fountain of wisdom. I don't think he understands anything about economics and cycles. Well, nothing.
He doubled the S&P 500's returns for 40 years.
Because he's a value investor. Good. That's what's good about him.
Yeah. And so I don't do the hero worship thing. I just pick the snippets that I think are useful. So in this case, the snippet that I think is useful is that if you take all of the world's productive assets and you divide up their ownership amongst people, and then that's like one universe. And then you have this other universe where you take up all the world's productive assets, and then you add, quote, active managers that try and derive extra yield somehow magically. The productive stuff is still just the productive stuff, and the people that own it are still just the people that own it. And that extra class of people pretending to add value doesn't actually add any value. Right. And so his statement was that non-actively managed index funds would outperform actively managed funds over 10 years. And he made like $1 million bet on it, and he was right. And so it's, for me, it's the same with health insurance. Health insurance providers do not treat anyone. They are not doctors. They do not treat you. What they do is steal a third of the money that could have been used for treatment for bureaucracy. They don't do a fucking thing. They don't develop new medicine. They don't deploy new medicine. Everything sucks because it exists. So
they're there if you need an extreme amount of money, which most people don't. And you know how much savings most people have, don't you? That's the only thing they provide. I agree with it. It's not enough compared to what that they're taking.
So my point is that like there's these ways to make systems more efficient by cutting out people that pretend they're doing work, but they're really not doing anything. And so insurance companies are one of those things. And some of finance is that. The active management is that by and large.
Yeah, we would be just fine with no active management. I agree with you. It doesn't add any real value long term.
Well, particularly when you've got a democratization of signals, as you have said. I mean, you went to Harvard, so you're a pretty smart dude, but you still are an armchair, became an economist just because you had to, because everyone else was so bad at it. Yeah. I mean, economists, if you want to talk about people that can't make any damn money in the market, economists cannot make any money in the market. They get wrecked left and right.
Richard, never had sex, never run a business.
Yeah, there you go.
They're smart people, but those two things tell you why they don't understand real life.
Yeah, but
consumers drive our economy. They wouldn't know a consumer if they fell on them.
Yeah, I hear you. So the point that I'm getting to is when the government is willing to do something that they've never done before, which is actual health. Like people have always rumored like, oh, helicopter money. We actually have helicopter money now. They've inflated the M2, which is a measurement of free capital in the system, the kind of dollars that are available. 80% of all dollars that exist were printed in the last year or two. It's a big deal. And so when that money that's being printed has to land somewhere, period. And it's landing, so the rich are going to get richer, the poor are going to get poorer. Your wages aren't going to go up. You're going to lose your jobs.
Do you know where it's landing? It's not going into the economy. It's not.
No, it's going into GDP, it's going into anything you can invest in.
It's going into financial assets, which you're right, are owned 80% by the top 10% and mostly by the top 0.1 to 1%. You're exactly right. It makes the rich richer, adds nothing to the economy other than they're spending more money.
Right,
and
they're getting more.
The top 10% are almost 40% of GDP, so they're more than they sound like spending. Other than that wealth effect on spending, and that's artificial. It's not. You're right. It's not adding anything. That's why bubbles need to burst. They're unproductive uses and diversions of money. And everybody's in the stock market. Everybody's a day trader now. Everybody's a real estate flipper. Those are not productive assets. And guess what? I've got a measure for what you're saying, Richard, and I'm going to give it to you afterwards, okay? Money velocity. Mm-hmm. Money velocity tells you when money's being invested productively and then reinvested and when it's not and it's going more into unproductive investments or speculation. Guess how long money velocity has been crashing in most countries around the world?
Well,
since the mid to late 1990s, since all these bubbles started.
Well, it's a function of interest rate. So when they literally raise interest rates to reduce money velocity, to make it harder to get money, to lower prices so prices don't rise. So like if
No, I'm disagreeing with you. It's actually the opposite. They have pushed interest rates increasingly lower, lower, lower. So money's free. So when something's free, it gets abused. People just speculate with it. It's easy.
Well, that's what I'm saying. Like the
lower interest rates have caused that, not higher.
Yeah. Well, that's what I'm saying.
Money
is when they want
velocity
to
is
slow it
totally
down.
consistent with falling interest rates, artificially below what inflation rates would say they should.
I agree with everything you
which
just
is
said.
easily measured.
Yes, I agree with all that. I was saying that when the Fed wants to stop and slow down the money velocity, to slow down rising prices, they increase interest rates to suck money out of the economy to get it locked into savings accounts. And they do the opposite when they want to flood the market with activity to try and make up for a pandemic or whatever they feel like they need to make up for. Then they reduce interest rates to zero, and in some countries negative, which is hilarious. So
and let me just say that is what I would describe as the maybe single most unproductive function in the entire economy. I think we would do just fine with no central banks, period, except emergency funds when you get in a real crisis short term. All they do is tinker with the economy and jerk people around and do all this stuff and add not only no value, but more volatility, which actually takes value out.
But there's hidden upside to the American populace from this. So when when America is the reserve currency of the world and has debt and trade imbalances with other countries, when they devalue the dollars that they owe other people, they just pay them back with fake money, and then we get more for nothing. Like when the Asians are willing to work 16 hours a day, 6 days a week, someone benefits from that, and it's everyone else that's getting their products, iPhone users, right? So like the first world and the rich people is sucking the life out of the poor people in the third world through this inflationary tactics. The rich get richer, the poor get poorer. Everything, if you're a high school graduate and you want to buy your house, you're fucked. You're not going to ever be able to buy a house, ever.
Exactly. Another good reason for a bubble to burst. So the millennials will be able to afford to buy a house in the future. They have no chance of making money on stocks at these rates or buying a house and making money.
I just don't think they're going to let it burst. I think they'd rather see the value of the dollar.
Okay, Richard, then let's play this forward, okay? The bubble keeps going up, up, up. Have you noticed the trajectory of it? It's called exponential. You think the market can double and double and double and double so that it's worth right now, financial assets, by the way, I'll just quote you a real number. 6.5 times global GDP, stocks, bonds, and real estate.
Yeah, sure.
6.5 times. You know what normal is?
You know that's the Warren Buffett indicator you're quoting, right?
It's one of them.
Yeah, but it's called the Warren Buffett indicator, the ratio of stock prices to GDP.
I don't care, Richard. I don't care. You want to